Hey guys, I hate to interrupt, but I just wanted to take a moment to say if you're studying for the CPA exams and you like the visual learning approach that we take in this video, definitely check out Universal CPA Review's free trial. You can do this by going to www.universalcpareview.com, or you can click on the link in the description of this video. From there, you could take a sneak peek at Universal's platform, which includes animated video lectures, study guides, and practice questions with task-based simulations that come with video explanations that walk you through the solution step by step, kind of like having a tutor by your side. Okay, enough of that. Let's get back to it. Okay, so let's get to the good stuff. And we're going to start with step 1 at the highest of levels within our mental map. So we're going to talk about what is included as gross income. And within that list, we're going to start with salaries and wages. Okay, so we've broken this out into a high-level list of the items that should be considered wages. Okay, so starting this off with money received. All money received for income that has been earned is considered salaries or wages. Okay, so if you're working and you receive that paycheck every 2 weeks, that's obviously considered your wages. Okay, but keep in mind, if you find money lying on the floor, the IRS is still going to consider that taxable gross income. Okay, what about money that is of constructive receipt? That might be a new term to some of you. Constructively received refers to income that is available to you regardless of whether it is actually in your possession or not. Okay, so this is money that is basically received, right? This is Jim the mailman saying, I tried to deliver the check, but they weren't home. Okay, so let's stop right there and go through a quick example. Linda receives an annual salary of $100,000. In addition, Linda received an annual $1,000 bonus for work performed. Jim the mailman attempted to deliver Linda her bonus check on the last day of the tax year. However, Linda wasn't home to receive it. So what amount is she going to recognize as part of her gross income in the current year? Okay, so naturally she's going to include the $100,000 salary, right? That's the total amount that she received from work. Okay, what about the bonus? Yes, that is money that she received from working, but she didn't actually receive the check. I thought we said that only cash received is going to be considered taxable income, right? Isn't tax reporting the cash basis of accounting? Yes, but this is considered of constructive receipt, right? We remember that Jim the mailman tried to deliver it, but she wasn't home. Okay, so next up we have property compensation. So this is property received in lieu of cash. Okay, so if Planet of the Grapes is saying, Linda, we can't pay you cash this week, but instead we're going to give you this piece of art. It had an original cost of $50,000, but it has a fair market value of $100,000. Linda's going to report that to the IRS at its fair market value of $100,000. Okay, so how about bargain purchases? Can you say discount? Because that's all this is. This is a discounted purchase. Okay, so this is Linda working at the vineyard. And part of the deal is that she could buy as much wine as she wants at 50% off. Okay, so this is still going to be reported as Linda's gross income. So she's just going to take the fair market value of that wine. We're going to reduce it by the purchase price, right, the amount that she bought it for, and the difference is going to be reported as gross income. All right, so this is included as her taxable gross income. Another situation is guaranteed payments. Okay, so we're thinking specifically about a partnership. Guaranteed payments are payments made by a partnership or a separate business entity without consideration of that entity's income. Okay, so this is guaranteed compensation to the partner that is receiving that compensation. So very similar to the salaries received by an employee in that it's still getting recognized as income, only this is when a partner within a partnership is running the business and the company is paying them for that service. Okay, so let's take a look at a quick example. Peter Pan Partnership is owned by Linda, Dick, and Tracy. Each person owns 1/3 of the partnership respectively. Dick is the operating partner of the business and gets paid $100,000 as a guaranteed payment. So the remaining $300,000 will be distributed equally amongst the 3 partners. In addition, Peter Pan sold the company car to Dick. The car had a $300,000 fair market value, but it was purchased by Dick for $180,000. So we want to know what amount is going to be taxable to Dick in the current year. So first of all, we're going to take the $100,000 received from the guaranteed payment, right? This is the compensation received for the work that has been earned. Okay, but Dick also received a profit distribution, right? The remaining $300,000 from the profits are getting distributed equally. $100,000 is getting reported on Linda's tax return, $100,000 is getting reported on Tracy's tax return, and $100,000 is getting reported on Dick here's tax return. All right, but what about this company truck that was sold to Dick? Expensive truck, had a fair market value of $300,000, but was sold to Dick for $180,000. Okay, so the difference is going to be considered a bargain purchase. So $120,000 is also going to be reported on Dick's tax return. So the total amount that is getting reported is $320,000. $100,000 from the guaranteed payment, $100,000 from the profit distribution, and $120,000 from the bargain purchase. Okay, and last but certainly not least, we have services. So instead of paying cash, we're going to fix your pipes. So the service that is getting received in lieu of cash is going to be reported at its fair market value. Okay, so Tracy works full-time at STD Contractors in the current year. A client of the company was experiencing cash flow problems, so Tracy instead accepted alternative methods of compensation. Tracy's compensation for services rendered are as follows. She received legal services with a fair market value of $10,000. She also received a warehouse with a fair market value of $50,000 and a net book value of $35,000. So how much is Tracy going to report as taxable income in the current year? So we have a combination here. We have services as compensation and property compensation. Both are getting reported at the fair market value. Okay, so that's what both of these have in common. Service compensation and property compensation both getting reported at their respective fair market values. So the total amount would be $60,000, $10,000 for the legal services, and $50,000 for the fair market value of the property compensation. Ooh, let's take a quick break and catch our breath. If you like what you see in this video, well, you're not the only one. Many students who've studied with Universal CPA Review have found a ton of success. If you don't believe me, you can see for yourself by taking a look at our reviews on Trustpilot. Trustpilot is the most legitimate third-party review site that ensures that our reviews are completely valid. Universal CPA Review is not only the best CPA exam study option for visual learners, but it's also the most cost-effective option out there. So if you've already spent thousands of dollars on other CPA review courses, we totally understand and we want to help you out. So take a look at our free 7-day trial to see if Universal CPA Review is a good fit for you. You can check out our free trial by going to www.universalcpareview.com or simply by clicking on the link in the description of this video. Alrighty then, we are now going to talk about more taxable income, money that we have to pay to the IRS. Okay, and this time we're going to talk about taxable income from distributions. So remember how we said that Linda Larper is a day trader for fun? Well, some of her investment portfolio will provide her with taxable income from distributions. So two of the big income items that we're going to talk about will consist of income from portfolio income. All right, and what you're going to learn about portfolio income is that it's very different from passive income, in that portfolio income is more of income from this investment type activity. Okay, so if we're buying securities of sorts. So focusing on both interest income and dividend income. Starting off by talking about interest income. So what is interest? Well, Merriam-Webster Dictionary defines this as money paid regularly at a particular rate for the use of money lent, or for delaying the repayment of a debt. So in many cases, interest is going to be paid back in association to bonds or other debt agreements. So for the exam, what's most important to identify is what types of interest income is going to be included versus excluded, right? AKA what type of interest income is considered taxable interest income and what type of interest income is considered non-taxable. So in short, we're going to focus more heavily on the income items that are considered non-taxable, because what you're going to find is that this list is much shorter, and they do love to trip you up on gross income type questions by sneaking in one of these interest income items that is non-taxable. Okay, but we're going to also be running through the interest income items that are considered taxable. So this will consist of interest income from federal bonds, interest income from corporate bonds, interest from industrial bonds, imputed interest on below market loans, or interest received from federal or state government for late payments of a tax refund. Okay, it can also be interest from life insurance proceeds. Okay, but something we're going to harp more on when we get into the non-taxable portion of this lecture is that if you just remember these three non-taxable interest income items and assume that everything else is considered taxable, you will be generally fine, okay? But we'll get more to that in just a little bit. Okay, so the next income item is taxable dividends. What are dividends? Dividends are money that is paid out by a company from their shareholders' equity, right? If they have all this income and then they have retained earnings, the income that is distributed to the shareholders is a dividend. So if Linda owns Big Bull stock and Big Bull pays her a 10% dividend, we want to know if that dividend is considered taxable to Linda. And what you need to remember is that if the dividend is considered tangible, then it will be considered taxable, right? In other words, if Linda is receiving something specific that she can feel or touch, then it's going to be considered taxable. Okay, so in other words, cash dividends and property dividends are going to be considered taxable to the recipient. And something to remember, property dividends is very much the same as property compensation in that the property received will be taxable to Linda at its fair market value. Okay, but if Linda received a dividend that is not tangible, right, more stock of sorts, then she would not pay tax on this. Okay, so we'll talk about that more in just a little bit, but things like stock dividends, stock splits, return of capital, life insurance dividends, those are not taxable. It's only going to be taxable if it's something that she can feel or touch, like cash or property.